Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for October 3rd, 2015. The market is in bearish normal conditions on an annual basis using weekly RSI. We're at 41 out of 100, so the lower end of neutral. On a 10-day basis with the 10-day NDX, we're higher end of neutral at 75 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is minus 4.60%. So we're 2.5% underneath the boundary for bear markets. The slope of the 50 remains very negative, red bearish at minus 0.86. ADX 14 shows neutral with respect to the trend, although the bears are still in charge. The risk index is the 30-period moving average of the VIX divided by the 10-period moving average, with a threshold of 1.0 as the boundary between risk on and risk off. The current reading is at 1.083, or risk on, and you can see a 90-day histogram of that indicator here. We've moved from minus 4 sigma to plus 1 sigma, a 5 sigma move as volatility has been draining out of the market. And so we are cautiously optimistic about looking for swing trades once we can get some closes and holds above the 200-day moving average. But right now we're still emphasizing the intraday trades primarily. Blended monthly rebalancing. Next reevaluation is on or about 1 November, still holding the same holdings from the previous month with TLT and then 2 scoops of cash. And you can see the leading candidates in the ETFs as of the close on Friday. In ETF2, the theoretical exposure remains at 0%. The model portfolio is at 10% exposed. I'll leave this up for you to take a look at the ETF 13 and 32 portfolios, see dominated by cash holdings. And in the ETF 32, only utilities have crept into a positive zone for the equities. In the ETF Max, you can see the major losses here in the volatility ETFs, and the ETF stack is still being dominated by income ETFs. The S&P 500, some minor gains here in Cablevision and TECO Energy during the week. VeriSign is of interest to us. It's early in the life cycle of gains. Vulcan Materials and Gannett would be looking for follow through on that on those gains for momentum. This is the market health check, and you see we're still well under the 200 period moving average, so in this reddish zone. Nice gain on Friday. That's the kind of one-day intraday directional trend that really will pay off for the intraday trader who's prepared to be direction neutral and simply follow the price where it wants to go. But a very strong intraday trend on Friday. That still leaves us almost 8% sold from the sell-off from the previous swing high. We're just getting back to the Bollinger Band mean. That's where you would expect it to move to, and so it's poised in a location where it could follow through to the far side of the river and floodplain, or go back and test down here at 196. So a very vulnerable market here, as it had just put in a double bottom this week. You can see that we're almost in the oversold here on Williams percent R10, and that the jaws of PPO have started to open to the upside here. So if we make this play as a continuation on Monday, starting with the intraday trade, we're looking at the far side of the river, far side of the floodplain, and then testing the 200-day moving average. Failure to the downside, we'd be targeting 195, and then if that collapses, down here to 193. All cash in the regional world market model. You can see that all of the S&P spiders are on cash positions except for utilities. In the world market model itself, treasuries and corporate bonds are doing very well. Staples and utilities and discretionary leading the way in the U.S., but everything else in Asia and most of Europe is, and certainly Latin American emerging markets, all below average. The U.S. is split between above average on the large caps and growth side, and slightly below average on the small caps and value side. The ETF 30 lens, using the ETF2 discipline, gives us the same kinds of insights, still dominated by interest-generating ETFs. Inside the Dow, Microsoft has now rejoined the top of the stack, up here with Nike, but Nike is a clear winner. And enduring strength still Home Depot, Visa, McDonald's, and Goldman Sachs. Weakness down here in DuPont, Caterpillar, United Tech. Shifting to the daily report. 1 5-day down in Verizon, and an overreaction short signal in Intel. Verizon is also an RSI2 candidate here. In the ETFs, only 2 symbols testing out well for the auto framer, and we have overreaction short signals in silver and utilities. The auto framer and the regression line fractal framework, for those of you looking for the trade setups on the basis of trade location. Just a handful of squeezes fired. And that's everything I want to cover. I'll flash through the slides real quick for you. And in my view, what our position right now is to continue to shorten up our time frames, emphasize the intraday trade until the market starts breaking down once more, in which case we could be tempted for short side swings, or till the market gets above the 200-day moving average before we start looking at taking a lot of swing signals. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.